Shanghai just paid 12% more for silver than the rest of the world. Same metal, same day, same hour, but two very different prices. While COMEX told traders silver was falling, China was buying it at a premium nobody in the West wanted to admit was real. This is not a rumor. This is not a theory. This is a number sitting quietly in the data while everyone else was watching the Fed. Welcome back to Currency Arc Insight, where we track the signals the mainstream financial media chooses to ignore. Today, we examine a growing disconnect between the price you see on your screen and the price the world's largest physical buyer is actually paying. On the afternoon of August 13th, 2026, two numbers told two different stories about the same metal. In New York, silver spot price slipped to $64.78 an ounce, down 0.83% on the day, retreating from a 7-week high it had touched just hours earlier. In Shanghai, on the same day, silver traded at a premium of over 12% above that Western price. Same commodity, same 24 hours, two markets moving in opposite directions. For most investors watching a ticker, that gap would look like noise, a rounding error, a quirk of currency conversion, or time zone lag. It is not. The Shanghai premium is one of the most closely watched signals in the physical precious metals market, and right now it is flashing a message that the futures market in New York is not. To understand why, it helps to separate two very different things that both get called the price of silver. The first is the price traded on COMEX, the New York Futures Exchange, where the vast majority of contracts are never settled in physical metal. Traders buy and sell paper claims on silver, often hundreds of times the actual bullion that exists to back them. This is the number that appears in headlines, on financial news tickers, and in most investment apps. It reflects sentiment, interest rate expectations, and short-term positioning as much as it reflects any physical bar of metal. The second price is the one set at the Shanghai Gold Exchange on a contract known as AG T plus D. This is a market where the metal is expected to actually move, where buyers are, more often than not, industrial users, refiners, and institutions taking physical delivery rather than closing out a position before expiration. When this price consistently runs above the Western spot price, as it has today by more than 12%, it is not speculation driving the gap. It is real buyers in China paying real money to secure real ounces, even when it costs more than the global benchmark says it should. This is not a one-day event. Over the trailing history of this premium data, going back to January 2024, today's 12% reading sits higher than roughly 84% of all daily closes on record. That places the current gap firmly in elevated territory, not as an outlier spike, but as part of a sustained pattern. Earlier this year, during a sharp correction in February, that premium briefly widened to over 34%. As Western prices cratered faster than Chinese demand did, the premium has cooled somewhat since then, but it has not disappeared. It has simply settled into a persistently elevated range, one that keeps reasserting itself every time global sentiment sours. Here is the tension that matters for anyone trying to understand where silver goes next. The paper market, the one setting the price most investors see and trade against, is currently pricing in caution. Today's pullback came alongside a stronger US dollar index and profit-taking after silver's recent run towards 7-week highs. It is a market responding to short-term positioning, interest rate speculation, and technical resistance levels. The physical market, the one where metal actually changes hands for delivery, is pricing in scarcity. Chinese buyers are not looking at COMEX futures curves. They are looking at available supply, and they are willing to pay a meaningful premium to secure it now, rather than wait for a lower price that may not come. These two markets cannot diverge indefinitely. Historically, when the physical premium runs this hot for this long, one of two things happens. Either Chinese demand eventually cools, and the premium collapses back toward parity, or Western spot prices are forced to catch up to what the physical market has already been signaling. So far in 2026, more often than not, it has been the second outcome that has played out, which raises the question that will guide the rest of this analysis. When the price you see on your screen, the price the world's largest physical buyer is actually paying, tell two different stories, which one is the lie and which one is the warning. To understand why a 12% gap between two markets matters, it is worth taking a step back and asking a simpler question. What exactly is the Shanghai Gold Exchange's AG T plus D contract, and why does its price behave so differently from the one traders watch in New York or London? The T plus D structure stands for deferred delivery. Unlike a standard futures contract, which can be rolled forward indefinitely without ever touching physical metal, the Shanghai contract is built around the expectation that delivery happens. Participants trading on this exchange are overwhelmingly entities with a genuine industrial or investment need for physical silver, refiners sourcing raw material, manufacturers securing inventory for electronics, solar panels, and battery components. Institutions and high net worth buyers accumulating bullion they intend to hold, not trade, in and out of within the same session. This is the fundamental difference between Shanghai and COMEX. COMEX is, at its core, a paper market. Estimates of the ratio between contracts traded and physical silver actually available to back them run into the hundreds to one. Shanghai is closer to what a commodity market is supposed to be, a venue where price discovery happens because people are buying and selling the actual thing. That structural difference is exactly why the premium exists, and why it moves the way it does. When physical demand in China outpaces what is readily available on the exchange, the price on the SGE has to rise relative to the global benchmark to draw more supply into the Chinese market. Bullion has to be economically incentivized to flow east. A widening premium is the market's way of saying, quite literally, come here. The scale of these premiums over time tells its own story. Going back to January 2024, the widest single-day premium on record came during the crash session of early February 2026, when Western spot silver collapsed more than 22% in a single close, while the Shanghai benchmark fell a comparatively modest 15%. That mismatch briefly pushed the computed premium to over 34%, an extraordinary gap that reflected panic selling in the West, colliding with buyers in China who saw the plunge as an opportunity rather than a warning. Today's 12.3% premium is nowhere near that extreme. But context matters here more than the raw number. That reading currently sits higher than roughly 84% of every daily close recorded since the start of 2024. In other words, this is not a modest background level premium that occasionally ticks up during stress events. This is a premium sitting near the upper end of its own 2-year range on what is otherwise a fairly ordinary trading day, with no crash, no crisis headline, and no single catalyst driving it. That distinction is the entire point. A premium that spikes for one day during a crash is a liquidity event. A premium that stays elevated week after week through calm markets and volatile ones alike is something else entirely. It is a structural signal. It tells you that Chinese physical demand for silver is not an occasional surge tied to a single news cycle. It is a persistent, ongoing pull on available supply that keeps reasserting itself regardless of what the Federal Reserve says, what the dollar index does, or what today's headline happens to be. This is why analysts who track physical flows treat the Shanghai premium differently than they treat a single day's price move on COMEX. A futures price can be pushed around by algorithmic trading, short-term positioning, and speculative flows that reverse within hours. A sustained physical premium reflects something slower and harder to fake. Real buyers, in one of the largest silver-consuming economies on Earth, consistently willing to pay more for metal they actually intend to take delivery of. The mechanics are simple. The implication is not. When the market where real metal changes, hands keeps pricing silver meaningfully above the market where paper contracts dominate, and does so consistently rather than as an isolated spike, it raises a structural question that goes beyond any single trading session, one that the next part of this analysis will take directly to the buyer, setting the pace for all of it, the People's Bank of China. Behind the silver premium sits a much larger story, one that has almost nothing to do with silver at all. It is a story about gold, and about a central bank that has been quietly reshaping its reserves for nearly 2 years, largely outside the notice of anyone not paying close attention to monthly reserve data releases. The People's Bank of China has now added to its official gold reserves for 21 consecutive months. In July alone, the central bank purchased roughly 640,000 troy ounces, just under 20 tons, its largest single-month addition since 2023. That followed a nearly 480,000 ounce addition the month before. Year to date, China's official gold holdings have grown by close to 60 tons, pushing gold's share of the country's total foreign exchange reserves above 8%, a figure that has been steadily climbing for years. What makes this streak remarkable is not simply its length, it is its consistency. This buying has continued through every Federal Reserve communication cycle since November 2024. Hawkish meetings, dovish meetings, rate hikes priced in, rate hikes priced out. Inflation surprises in both directions. None of it has interrupted the pattern. A central bank calibrating its purchases to short-term price movements would show gaps, pauses, moments of hesitation around major data releases. The PBOC's record shows almost none of that. It behaves less like a trader responding to a market and more like an institution executing a long-term policy decision that has already been made, one that simply continues regardless of what the price happens to be doing on any given week. This distinction matters enormously for how investors should interpret the broader precious metals story. Speculative demand is price-sensitive by nature. It surges when prices are rising and momentum feels safe, and it retreats when prices fall and uncertainty creeps in. Sovereign reserve accumulation, when it behaves the way that PBOC's has, is closer to the opposite. It reflects a structural view about the future of the monetary system, a hedge against currency risk and reserve concentration that does not particularly care whether gold is up 3% or down 3% this month. The World Gold Council's own survey of reserve managers this year found that the overwhelming majority expect global central bank gold holdings to keep rising. and a clear majority expect the dollar's share of global reserves to shrink over the coming years. China's buying pattern looks less like an exception to that trend and more like the clearest example of it in action. It is a broad, ongoing preference within China for hard assets over paper claims, for physical metal over financial promises. The PBOC's gold buying is the sovereign-level expression of that preference. The Shanghai silver premium is its retail and industrial-level expression, private buyers, refiners, and manufacturers making the same calculation on a different metal day after day in a market that most Western investors never look at. This is why treating the silver premium as an isolated one-day anomaly misses the larger picture entirely. It is not happening in a vacuum. It is happening inside an economy where the central bank itself has spent nearly 2 years demonstrating, purchase by purchase, month after month, that it no longer wants to hold its reserves the way it once did. When the institution setting monetary policy for over 1 billion people is steadily converting reserves into gold regardless of price, it should not be surprising that the same underlying appetite shows up in how much Chinese buyers are willing to pay for silver as well. The paper markets in New York can price silver however short-term sentiment dictates. But underneath that daily noise sits a much slower, much heavier signal, a sovereign buyer that has already decided what it thinks these metals are worth, and has been acting on that belief consistently for 21 months running. If the Shanghai premium reflects physical reality, then COMEX, the exchange setting the price most of the world actually sees, deserves a closer look at what it is really pricing. Because on a day when every structural signal pointed toward tightening physical supply, the Western spot price still fell. Understanding why requires understanding what COMEX actually is, and just as importantly, what it is not. COMEX is, first and foremost, a futures market. The contracts traded there represent an agreement to buy or sell silver at a future date, and the overwhelming majority of those contracts are closed out, rolled forward, or offset long before anyone takes physical delivery. Estimates of the ratio between the ounces of silver traded on paper each day and the ounces of actual physical silver available to back those trades run into the hundreds to one. This is not a flaw in the system so much as its design. COMEX exists primarily as a price discovery and hedging mechanism, not as a physical marketplace where metal routinely changes hands. That distinction explains today's price action perfectly. Silver spot fell 0.83%, slipping back under $65 after touching a 7-week high earlier in the session. The immediate drivers had almost nothing to do with mine output, industrial demand, or available bullion inventories. They had everything to do with sentiment and positioning. The US dollar index strengthened back above the 100 level, and a stronger dollar mechanically pressures dollar-denominated commodities like silver and gold. Traders who had pushed silver toward those 7-week highs took profits. None of that reflects a change in how much physical silver exists or how badly buyers in China want it. It reflects short-term flows in a market built for exactly that kind of rapid repositioning. This is where the paper versus physical gap becomes impossible to ignore. On one side sits a market trading enormous volumes of silver that will never be delivered, moving on interest rate expectations, dollar strength, and technical momentum. On the other side sits a market in Shanghai where buyers are paying a sustained double-digit premium to secure metal they actually intend to hold. The volume in the first market dwarfs the volume in the second. But volume is not the same thing as scarcity, and price is not the same thing as availability. A futures exchange can generate effectively unlimited paper ounces. It cannot generate unlimited physical bars. Now layer in the macroeconomic backdrop, because it reinforces exactly this point rather than contradicting it. July's consumer price index came in at 3.4% year over year, down from 3.5% the month before, marking a second consecutive month of cooling inflation. Core CPI held at 2%, in line with expectations. On the surface, this should have been unambiguously supportive for precious metals. Cooler inflation reduces the case for further Fed tightening, and lower rate expectations typically lower the opportunity cost of holding non-yielding assets like gold and silver. Market pricing followed that logic, with September rate hike odds falling to roughly 40%, down from near 50% just a day earlier. And yet, silver fell anyway. Gold fell alongside it, down over $30 on the day. If Western pricing were purely a function of physical scarcity, a dovish CPI print paired with easing rate hike expectations should have pushed prices higher, not lower. Instead, the market did what paper markets do after a sharp run-up and took profits into good news, let the dollar's bounce dictate the next move, and treated a 7-week high as a level to sell into rather than a level to chase. This is the clearest evidence yet that COMEX pricing right now is being driven by short-term rate speculation and technical positioning, not by any genuine read on physical supply and demand. The physical market in Shanghai does not have that luxury. It cannot simply reprice based on a Fed rate probability shifting by 10 percentage points overnight. It has to reflect what buyers are actually willing to pay for metal that actually needs to change hands. And right now, that number keeps landing meaningfully above whatever COMEX says silver is supposedly worth. The picture has moved from a single day's price gap to something far more structural. A 12% premium in Shanghai, a central bank that has bought gold for 21 straight months without pause, a Western futures market reacting to dollar strength and rate speculation rather than physical scarcity. Taken individually, each of these is a data point. Taken together, they form a pattern, and patterns like this one have a track record worth examining closely. History offers a useful guide here. When the Shanghai premium runs persistently elevated, as it has for much of 2026, the gap between the two markets has not tended to resolve by Chinese demand simply fading away. More often, it has resolved through Western spot prices eventually moving to close the distance. This happened following the winter of 2025 into early 2026, when premiums pushed into the double digits and then spiked to over 30% during the February crash, only for global spot prices to recover and grind higher in the months that followed. The physical market led, the paper market eventually caught up. That is not a guarantee of what happens next, but it is the pattern that has played out repeatedly across this cycle, and it is the reason analysts who track this premium closely tend to treat it as a leading indicator rather than a trailing curiosity. There is also a fundamental backdrop reinforcing this dynamic, one that exists independent of any single day's Fed commentary or CPI print. The Silver Institute continues to project another annual supply deficit for 2026, even as it has moderated its industrial consumption forecasts. This would mark yet another year in a now multi-year stretch where global silver demand, spanning industrial use, investment demand, and physical accumulation, has outpaced what mines and recycling can supply. A persistent physical premium in the world's largest silver-consuming region is not appearing in isolation. It is appearing against a backdrop where the structural math of supply and demand has already been strained for years. Put these pieces together, and the picture becomes difficult to dismiss as coincidence. A market with a documented worsening supply deficit, a sovereign buyer accumulating hard assets on a schedule that ignores short-term price, a physical exchange in the country most exposed to that supply tightness consistently paying more than the West's benchmark price, and a Western futures market that, by its own trading mechanics, is structurally positioned to lag physical reality rather than lead it. None of this means silver moves in a straight line from here. Paper markets can stay disconnected from physical markets longer than many investors expect, and short-term moves will continue to be dictated by dollar strength, rate expectations, and technical positioning, exactly as today's pullback demonstrated. But a premium this size, sustained this consistently, sitting in the upper range of 2 years of data, is not something a serious investor dismisses as noise. It is a signal. Whether it resolves quickly or slowly, the direction it has historically pointed toward is Western prices moving up to meet Shanghai, not the other way around. The question this series opened with remains the one worth sitting with. When the price on your screen and the price the world's largest physical buyer is actually paying tell two different stories, the gap between them is not something to look past. It is something to watch closely, because more often than not, one of these markets is about to prove the other one right.